when AI-driven equities surge to record highs while bond markets flash fiscal and inflation warnings. Cross-asset signals become harder to read. You are watching vTalkInsight, Allocator's Lens Daily for August 6, 2026. Let's unpack how today's setup lines up across equities, rates, credit, currencies, and commodities. In equities, the dominant theme is record highs powered by artificial intelligence, enthusiasm, and remarkably strong earnings. Major benchmarks in the United States and Europe have pushed to fresh peaks, helped by a sharp multi-day rally in the S&P 500 that adds up to nearly 6% in just 4 sessions, a move that historically often occurs near late cycle phases. At the same time, volatility measures remain elevated rather than collapsing, which suggests the rally is being chased, not calmly owned. The backdrop for that price action is powerful earnings momentum. The S&P 500 has now delivered 7 consecutive quarters of double-digit profit growth, and this season more than 60% of companies are beating expectations, with overall earnings up close to 50% year-on-year and revenues growing in the high 20s. Importantly for allocators, that strength is broadening beyond mega-cap technology into sectors like financials and healthcare and across regions. European corporates are seeing positive surprises in roughly half of reports, with earnings up in the mid-teens and miners, industrials, and banks all benefiting from infrastructure and AI-related investment. The AI story sits at the center of this equity regime. Large technology platforms are collectively on track to lift AI-related capital expenditures by around 80% this year, toward roughly $740 billion. And enterprise demand for compute and data centers is so strong that even less competitive chip offerings are selling out. Commentary characterizes the AI earnings cycle as still early, only a few innings into what could be a long expansion, yet markets are already demanding clear monetization. Some leaders, like major chip designers, have sold off despite beating revenue estimates because guidance was not explosive enough, while several concentrated AI hedge funds have just posted monthly losses north of 20%. This leaves the equity risk-reward finely balanced. On one hand, forward earnings are projected to grow around 30%, and valuation multiples are actually a bit lower than at the previous peak in June, prompting some strategists to lift year-end targets toward 8,000 on the S&P 500. On the other, overall price-to-earnings ratios sit near historic extremes. Margin debt and other forms of leverage are elevated, and leadership is highly concentrated in a small AI complex. Even as under-owned areas like European cyclicals and healthcare look cheaper and are starting to see improving earnings trajectories. For cross-asset allocators, the key watch points are whether earnings breadth continues to widen, how quickly AI investment translates into visible cash flow, and whether upcoming labor and inflation data allow equities to live with still rising real yields. Turning to rates, bond markets are caught between reassuring inflation data and lingering fears of further tightening. Recent core consumer price readings around 2.6% year-on-year, with forecasts pointing towards something close to the Federal Reserve's 2% objective by year-end, support a benign disinflation and soft landing narrative. Labor market indicators are also cooling at the margin, with private payrolls reports coming in below expectations and unusual job losses in areas like leisure and hospitality, hinting that wage pressure may ease rather than reaccelerate. Against that, a vocal camp still argues for additional rate hikes this year. They point to persistent inflation in goods, services, and especially energy, and warn that moving too slowly now risks embedding an inflation premium that would require much harsher action later. This preemptive mindset keeps the policy debate live, even as some see quantitative tightening and balance sheet runoff adding to overall financial restraint, and it helps explain why market pricing leaves room for multiple incremental hikes if inflation data were to disappoint. The real pressure point is at the long end of the curve. Expectations for the 10-year Treasury yield have been pushed up toward roughly 4.75%, with commentary stressing that risks look skewed to even higher levels rather than lower ones. Importantly, this move is framed less as a loss of faith in the Fed's inflation fight, and more as a response to higher real yields driven by mounting worries over deficits, heavy issuance, and the Treasury's growing reliance on shorter-dated bills instead of extending maturities. For allocators, this environment makes rates both more attractive and more unstable. Yields across high-quality government and investment-grade markets now offer meaningful income, and some cushion against further rises. And in places like the United Kingdom, weak growth and softer energy prices are modestly supportive for duration. Yet uncertainty over U.S. fiscal policy, refinancing plans, and debt sustainability is fueling bouts of volatility. And there is growing discussion that a rising inflation risk premium and concerns about central bank independence could shift the traditional stock-bond correlation. The next few payroll and inflation releases, along with Treasury funding updates, will be critical for judging whether today's higher real yields settle into a stable range or keep grinding upward in a way that eventually bites risk assets. Credit sits at the junction of these equity and rate forces. Headline corporate spreads remain tight across most sectors, signaling that capital markets are still open, even as the cost of capital has clearly risen for large technology and AI names, reflected in wider credit default swap levels and heavier bond issuance to fund capex. Banks report strong deal pipelines and optimism about advisory and underwriting revenues, which aligns with talk of incentive pools rebounding by double-digit percentages in some areas and a potential pickup in initial public offerings. Beneath the surface, though, fissures are appearing precisely where the AI equity story is hottest. Bonds issued by hyperscale technology platforms, despite pristine balance sheets, have underperformed this year, with spreads widening by around 50 basis points while the broader investment-grade index stayed roughly flat. There is a sizable stock of structured products, estimated at several $100 billion, linked to these names. If confidence in the AI growth narrative were to crack, that paper could face forced selling and sharp price moves, amplifying any correction in the underlying equities. In contrast, many allocators see more straightforward value in parts of the municipal market. 10-year muni bonds in some states are offering all-in yields in the 6.5% to 7% range, after the intermediate part of the curve endured its largest sell-off of the year, leaving the curve steep without requiring investors to move to the ultra-long end. Fundamentals are generally solid, supported by strong tax receipts and resilient economic activity, although there is clear bifurcation in areas like private education and lower-rated healthcare, where credit risk is rising and careful selection matters. Private credit adds another layer of complexity. Large platforms report stable portfolios with no meaningful pickup in defaults and continue to attract interest. Yet industry-wide, the asset class has slipped from star performer to relative laggard, facing redemption pressure and weaker returns compared with other financials. At the same time, leverage in parts of the system remains high, and the bond market as a whole is described as vulnerable to shocks if growth slows or AI spending disappoints, given heavy supply and only gradually returning demand. For cross-asset allocators, credit markets are likely to be an early warning system. Sustained widening in AI-linked corporates, structured products, or weaker muni sectors would be a signal that the current balance between income and risk is starting to shift. In foreign exchange, attention is firmly on the yen and on the slow evolution of dollar dominance. The yen is hovering near levels that previously triggered official intervention, and recent comments from Japanese policymakers suggest growing discomfort with further weakness, especially if it is driven by rising U.S. yields rather than domestic fundamentals. There is also speculation that if Treasury yields keep grinding higher and the yen sells off sharply, U.S. authorities might be more open to coordinated action, which would make dollar-yen a very policy-sensitive pair. At the same time, cross-border flow dynamics are pulling in different directions. On one side, there is a global rush into U.S. equities, with investors looking for scale, liquidity, and exposure to the AI theme, which naturally supports demand for dollars. On the other, some asset owners are deliberately diversifying toward European and Asian equities and keeping those positions in local currencies, citing long-term worries about U.S. deficits and the desire to reduce concentrated dollar exposure. This push and pull is one reason global macro hedge funds continue to attract capital. Their ability to trade rates and currencies together is seen as valuable in a world where central bank paths diverge and where moves in dollar-yen can feed back into Treasury demand and term premia. Stronger or weaker intervention signals, combined with surprises in U.S. labor or inflation data, could quickly reshape carry versus volatility trade-offs in the major pairs. For allocators, that means foreign exchange is both a source of risk and a potential shock absorber. Currency choices increasingly shape the effective exposure of international equity allocations, especially when some markets are funded in dollars and others in local terms, and when policy divergence across the Fed, the Bank of Japan, and the European Central Bank is pronounced. Monitoring official rhetoric around yen stability, as well as evidence of persistent shifts into local currency holdings in Europe and Asia, will be key for understanding how FX feeds back into both rate markets and global equity leadership. Finally, commodities, and especially energy, continue to translate geopolitics and AI infrastructure into price signals. Brent crude has swung around the $80 level as markets respond to reports of progress toward a temporary mechanism to reopen the Strait of Hormuz, alongside renewed threats to shipping in the Red Sea. An interim deal between the United States, Iran, and regional mediators could allow limited oil flows for a defined period, which would ease recent supply disruptions. But ongoing conflict risk around key shipping lanes and unresolved regional tensions keep a risk premium embedded in prices. Beyond the headlines, structural forces are shifting the balance of the oil market. China has sharply reduced seaborne crude imports since the onset of regional conflict, which has helped prevent more extreme price spikes. And if Hormuz were fully reopened, supply could quickly move into surplus, potentially pushing prices lower even before inventories are rebuilt. However, extreme heat and drought in Europe are raising fuel demand while constraining refining capacity and logistics, with river levels on key routes like the Rhine threatening industrial supply chains and middle distillate cracks hovering near multi-decade highs. The AI build-out adds another layer to the commodity story. Surging electricity needs from data centers are stretching existing power generation, elevating the role of natural gas as a transitional fuel and increasing the importance of midstream infrastructure that can move molecules from supply basins to data hubs and end users. Investors describe unprecedented global demand for energy and digital infrastructure assets, with behind-the-meter power projects, pipelines, and liquefied natural gas capacity all in focus as ways to meet AI-driven load growth, while countries simultaneously pursue energy security and decarbonization. These dynamics feed directly back into the macro and cross-asset picture. Persistent strength in refined products or renewed spikes in crude would complicate the disinflation narrative and could re-energize the case for tighter monetary policy, while a durable easing in oil and gas prices would support the soft landing scenario that underpins current equity valuations. For allocators, watching how Middle East negotiations evolve, how quickly new infrastructure comes online, and how policymakers respond to climate-related bottlenecks will be central to understanding whether energy remains a tail risk or becomes a modest tailwind for growth. Stepping back across assets, the picture is one of powerful AI-driven equity gains running alongside higher real yields, tight but fragile credit markets, policy-sensitive currencies, and an energy complex that can still shift the inflation story. Upside scenarios rely on earnings breadth continuing to widen, AI capex translating into visible cash flows, disinflation persisting despite energy noise, and bond markets digesting fiscal concerns without another leg higher in yields. Downside scenarios center on an air pocket in AI demand, a sharper slowdown in labor data, or renewed commodity shocks that reprice both rates and risk premia. For multi-asset allocators, the practical watch list includes equity leadership and concentration, long end yield behavior around fiscal events, early warning signs in AI-linked credit, yen intervention rhetoric, and concrete progress or setbacks in Middle East energy negotiations. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.